Welcome to an overview of leasing. I'm Professor Larry Louie, and we're going to be going through the basics of lease accounting and reporting. Now, let's start with a caveat. This is an extremely complex and technical area. From an accounting standpoint, is it an asset when we rent something? Don't know. Do we show it as a liability, or do we just pay it when we owe it? Because we don't own the asset. We're leasing it from somebody else. What about different lease durations? Does it matter if it's over a weekend or over 5 years? And is there an interest rate on a lease? Again, we don't own it, so why is there interest? From a financial standpoint, does it impact the financial health of a company whether they lease or not? The other aspect is, does it impact the valuation of the firm? From a legal standpoint, there are widely varying terms and provisions, such as terms, rates, renewal, residual values, obligations to maintain and insure, even though we're not the owner. So these are legal parameters of every lease transaction. The objective of this video is to cover the basics of leasing. We're going to cover why bother leasing. Next is how do we show a new lease on the financial statements, followed by how do we show the lease payments as we make the payments during the life of the lease. And how does lease accounting impact our financial analysis of a company? Let's start with why lease, the most basic question. First, we know that companies need assets such as property, plant, and equipment, we call that PP&E, to operate and grow. There are three typical ways to acquire the assets that companies need. First is buy it, write a check, and buy the asset. The problem is we may not have available cash to do so. The second is let's borrow from a bank. We go to a bank, we write a loan, we get the money from the bank, we buy it from the vendor, let's say, the same Ford truck that we need. The complications are we have to apply for the loan. There's going to be a credit assessment done by the bank, and every loan requires a down payment. We would pay a certain amount for that truck, and only the balance is financed by the bank. Third is let's lease. Now, there are more circles on this diagram because there are more parties involved. We still want the truck, so Ford makes it easy. They said, well, you could buy it from us directly, but you can work through our Ford Credit Company, actually it's called Ford Motor Credit, and you could lease the truck from them. What's happening behind the scenes is that Ford transfers the asset to the leasing company, and then they get cash from the leasing company. The leasing company, in turn, now owns it, so they have the right, of course, as owner, to lease that truck to us. We sign a contract, we get the truck, much smaller payment than a down payment to purchase the truck, and then we'll make payments over the term of the lease to the leasing company. Now, you can see the advantages. There are far lower amounts paid up front in down payment or buying out the truck outright. And there's the right to keep the asset at the end or just simply give it back. Just say, I'm done with it, you take it, you dispose of it. So there are a lot of flexibility and financial reasons that companies prefer leasing. And because of that, there's a lot of leasing. I think you understand why people do this. There's an entire industry that does nothing but leasing. It's kind of in the background. We don't normally wake up in the morning thinking, how does leasing work? But I hope now you see the merits of leasing, that it's a viable and a very commonly used mechanism for companies to acquire the assets they need to grow their business. So let's recap the lease itself. The lease is a contract, think of it as a stack of paper, that the owner, the lessor, is going to then lease to the lessee, who's going to be the user, in our case, the company, for a period of time that's specified in exchange for specified payments. Oh, that's easy. I get the truck, I pay you for 5 years, X amount of money every month, and that's it. At the end of the 5 years, I give you back the truck. At a simple level, that's it. You make the payments without missing, and at the end, you give back the asset. So the advantages compares with buying in cash and with a loan. Short term, the lease could be for a weekend. You could rent a car or a truck for a weekend. You're doing a move. So why buy it? Why buy the car or truck? Equipment leases tend to be flexible. You could specify or negotiate terms like 3 to 5 years. I mean, some could be longer for more expensive, longer-lived assets like airplanes, but for something that's common, it would be 3 to 5 years. The lower payments up front are also attractive. It's not paying for the whole thing like a purchase or down payment like 20% down in the case of a loan. You're making maybe 1 or 2 of the payments up front just to kick you off of the lease. And that is much lower than the other 2 scenarios. And the credit. Now, I might be a little delicate about this. In my experience, it's easier to get a lease than a loan. The reason I say that, and I'll give you the most simple example, is let's say we're talking about you need computers, and you go to Dell. Now you go to the Dell website, and they have all these servers and computers and laptops that you may want to buy, but they make it very easy, and it's right on the page actually. You could lease it for X dollars a month. So now you see that Dell has a big incentive to get you to buy a Dell, but they know that you may not have cash lying around just to pay for it, or go hassle and go borrow money from a bank, go through all that to buy it from Dell. So they make it easy. They say, hey, you can buy from our leasing company, Dell Financial Corporation, and pay monthly payments is all set, and the underwriting is easier. Now, since Dell has an incentive and a profit margin from selling you that laptop, let's say, they won't be as tough as a bank. This is my personal opinion. If you ask Dell, they say, no, we're tough on credit. But my experience is captive leasing companies, as Dell Financial Corp is going to be much more agreeable to leasing than a tough bank, like going to B of A or Citicorp or something like that for a loan. So those are some of the basics of leases. I hope you understand the business side of it, because we're going to leave that in a moment and move to the accounting side. There are some additional typical terms that you'll see with leasing. Some relate to the contract itself, and all these, like many things we learn in business, are words we may not know or not know in this context, but once you understand it, oh, that's no big deal. So let's try to do that, so discard those jargon elements right away. First is term. What's the term? Well, you could probably guess this. It's how long is the lease, from the beginning of the lease to the end. The next one, it says, it's your commencement. Well, you're not graduating. Commencement in this context is the beginning date of the lease. What is the expiration? You guessed this one. It's the last date of the lease, similar to the maturity of a loan. So the term in leasing is the expiration date. What is the renewal? Renewal is that you don't have the obligation to renew after lease term, but you may have the right to renew. And often, if you still want to use that asset, it's still working fine, it's probably at a very financially attractive rate. So it may talk about renewal, but it's usually not an obligation. It's something that is at your option as a lessee at the end of the lease. Then there is the purchase option. Some of the lease contracts may specify that you have the right to purchase at the end of the lease. They may even specify the dollar amount, and it may even be just $1. In that case, we just call it a bargain purchase. Or it could may be a little vague, like it's the fair market value of the truck, let's say, because nobody really knows the value of the truck at the end of the lease term. So they may want to keep it flexible that yes, you can buy it, but we will agree upon a fair market value, and that will be the price. Residual value is a term that's often used for the value on the last day or the expiration of the lease, similar to the purchase option, but that may be specified in a clause called residual value. There might be, and this is not that common, frankly, the specification of what is the implicit interest rate. Now, don't get me wrong, there is always an interest rate that is built into the lease, because why would Dell, however generous they are, take a $1,000 computer and lease it for you for 5 years and let you pay $200 a year for 5 years? No, there's cost of money. It costs them, they're now your banker. So they deserve and should get some interest for your payments. So in the lease payment, which may be a specific dollar amount per month, is built in an interest rate. They don't have to tell you what rate they used, because you're just simply negotiating a number, which is the monthly payment. But behind the scenes, there is an implicit, from the word implied, right? There's an implied interest rate in the leasing amount that they don't have to specify. Why do I tell you this? You'll see this later on. From an accounting standpoint, we have to break out the payments of how much is like for the principal. I know it's not a loan, but it's like the principal for the asset, and how much corresponds to this implicit interest rate. So this implicit interest rate is a big deal, not so much in negotiation as much as for the accounting. So we'll just bookmark that in our brains for a moment. And there are a couple of industry terms that are thrown around all the time. Oh, I'm a captive leasing company. Oh, I'm a third-party leasing company. You can probably guess what those are. Dell Financial Corp or Ford Motor Credit are captive to the parent company of Ford or Dell. Whereas third party is somebody not associated from an ownership standpoint with the person that's selling the asset itself. So you could get a loan from B of A, you could get a lease from Bank of America Leasing, and then go to Dell and say, I'm going to add this to my lease equipment schedule, as often called, with Bank of America Leasing, and Bank of America will pay you, Dell, for the computer. So technically you're selling it to Bank of America, and then they're leasing it to us. You'll see the structure is very similar to that three-party leasing example we saw earlier. But it's a third party. It's not the owner or manufacturer of the asset to begin with. All right, now we have to get into the accounting. So let's start with the previous rules and then move to current rules. The reason this is important is that the differences are quite pronounced between the old treatment and the new treatment. And when you're doing financial analysis, you may cross over where there are certain years that they reported perfectly in compliance with GAAP and IFRS, but they look so different than what happens afterwards. So in order to analyze this period of time, we have to understand the before and after accounting, because you might be analyzing both before and after this pronounced change in the rules. So let's start with before. For decades, I say decades because I started my career doing auditing of leasing companies. That's why I'm quite familiar with leasing generally under the old rules, which were my rules. So for decades, accounting tried to match the accounting with the business objective and the economic reality. That's kind of the idea we have in accounting anyway. That's a point of view of accounting. It was just trying to make financial statements reflect reality so people can understand reality. Got that? So now we say, okay, you're going to lease the car for 5 years, and at the end you're paying most of the value of the car anyway, and you've used up most of the useful life of the car. So you guys are probably essentially buying the car, aren't you? So it's called a lease, it's documented a lease. Legally, you don't own the car, but the reality, the bottom line of it, is that you're paying for most of the car anyway. So they called that, from an accounting principle standpoint, a sales type or financing or capital lease. You've heard these, we use these terms somewhat interchangeably. But your purchase type lease, sales type lease, finance lease, or capital lease, they're all kind of implying this long-term nature that you're essentially finding a new way to pay for a capital asset that you want for your business. So that's the first type of lease. Let's call it a finance lease. The second is, oh no, I don't need that car for 5 years. I only need it for 5 days. I'm taking a long weekend driving down the coast. And you're going to return it on that 5th day. Well, you're just renting it, aren't you? So there's no long-term, high percentage of the value, high percentage of the useful life. No, I want the nice car for a weekend. Well, then forget about all this capital lease, sales type lease, or finance lease. This is an operating lease. So an operating lease was in that spirit that I'm renting a car for 5 days. So the accounting rules had those very distinctions. And the accounting rules were very different between finance type lease and an operating lease. So let's start with what that means. So a finance or a sales type lease, you record the liability and the value of the lease asset. So you say, okay, I have this lease for 5 years. I'm going to use that implied interest rate and break out the payment and take the present value of the principal of the payments to get to what is the present value, what would be like the loan amount right now. And then we're going to record right now that I have an asset in that amount and that I owe that amount of money. Now over time, over the 5 years, I'm going to be paying more than that amount because some of that payment was toward interest. So again, we split out the rent payment into interest payments and principal, in air quotes, payments to the lessor. So that was how we did it. What that means is every month you make a payment. That's easy, make a payment. But you depreciate the asset because we treat that asset as if you bought it. And then we take the payment and we break out the portion to a part that relates to paying interest and the other part that relates to paying principal. So it creates what looks like a loan out of a lease, right? So that's the first treatment, finance type lease. The second approach is, oh no, you rented it. So because of that, just pay the rent, charge it as expense. Notice the big difference. There is no asset recorded on the balance sheet. There is no liability recorded on the balance sheet. It's just like you renting a car for a weekend. So therefore, the financial statement, specifically the balance sheet, is dramatically different, whether it's a finance type lease or an operating lease. That leads to like the churning wheels of a CFO, isn't it? Well, you're right. It makes sense that we kind of have the accounting match kind of the reality that you and I, from a layman's standpoint, would see that is going on. So what went wrong? Well, clever CFOs said, wow, I want to structure my lease so that I barely qualify for this being an operating lease and not a finance lease. Why? I don't want to show that asset on my balance sheet. I don't want to show that debt on my balance sheet. If I show that asset, it's going to become the denominator on return on assets. So when they look at my profit divided by assets, I want that number lower so it looks like I'm making more profit. Makes sense, right? Lower the denominator, higher return on assets, more profitable, I look like a star. On the other side, the same thing applies. I don't want to show I have a lot of debt, because if I have a lot of debt and they look at my equity, they say, whoa, your company relies on debt. You're risky to me. So I'd rather have a balance sheet that has more equity as a percent of total assets, let's say, and therefore it looks like I'm more self-sufficient. I don't need liabilities. Now, we know this is false, isn't it? Because behind the scenes, and that's why we call it off balance sheet, behind the scenes, oh, we had some more assets we're not telling you about. Oh, we had some liabilities we didn't tell you about. And it's a lot of money, and it's going to go for 5 to 10 years for lease payments. But because of the accounting rules, I don't have to show you. So the clever CFOs were always tempted to structure leases so that they were treated as operating leases under the rules, and therefore it was off balance sheet. So the ridiculous example were airlines. We could look at many of the major airlines in the world, and they were leasing like crazy because they didn't want to show Boeing 747s on their assets. They didn't want to show massive multi-million-dollar liabilities on their liability side. So the most egregious example of abuse in the accounting rules came with people that have large amounts of capital assets that they acquired through leasing, through what they called operating leases, by just going to the edge of the definition of whether it's an operating lease or a finance lease. And that was how it was done for many years. Like I said, I started doing this in the 70s, so it went on for decades. And for decades, accountants and CFOs all were dealing with how do you characterize and classify these leases, and all financial analysts had to deal with, wow, are they doing a lot of stuff off balance sheet that I ought to be aware of and concerned about? So there was this big game that was predicated on the accounting rules that made the distinction between operating and finance lease. So eventually this was kind of getting out of hand. So FASB and the IASB both said, okay, we're not going to do this. Instead of creating this game to create what is an operating lease, everything is going to be treated as a transaction that requires capital. In other words, we want to show the asset of that leased asset on the balance sheet, and we want to show the obligation. Whether or not it's classified as an operating lease or a finance lease and all that kind of finding that line of distinction, forget it. We're capitalizing everything into assets and showing the liability as assets. So that's the spirit of the change in the old accounting rules and the new accounting rules. In FASB, it's the Accounting Standards Codification called ASC 842, right? And that was effective December of 2018. For IASB, they called their rule or change of rule IFRS 16, which was effective January of 2019. So essentially the same time, within a month or so of each other. Well, actually within weeks of each other, they had this standard, right? So thankfully, FASB and IFRS are very similar in the treatment. Ooh, similar. That means not identical. Yes, this is another FASB IFRS difference, but let's look at those in turn. All right, let's look at the actual pronouncements. And the general concept is that now almost all lease transactions must now be shown on the balance sheet as assets and liabilities. And they're called right of use, like a lease, right of use assets, and lease liabilities. Okay. The exceptions are pretty small, like short-term lease, 12 months or less, or very low-value leases. You're leasing a stapler. You would never lease a stapler, but you get the idea. Something that is de minimis, we use that term. It's such a small amount. Let's not bother with all this accounting for it. Let's keep it that way. Like you lease a printer, a couple $100 for 12 months. So those are the exceptions. So everything else, whether it's a truck or an airplane or computer equipment, all those are leased. And they're all going to be shown on the balance sheet as assets and liabilities. Now the value of the leased or right of use, ROU, asset is equal to lease liability when you put the asset on the books. So that's the idea. We figure out what is the present value of all these payments we're going to make under the lease. I'm not calling it operating or finance at this time. Take the present value of the lease. That's the amount. That same amount is the value of the asset. And then we're off and running. So that's the idea at the inception or the commencement of that lease. Next comes a slight deviation between ASC 842 and IFRS 16. Under the FASB or ASC 842, we still have titles of two different types of leases, finance and operating. Now, the distinction of how we account for it is much more toward a finance lease than the previous practice. We still have to do the same present value thing to get the liability and asset. But in the case of a finance lease, we will then have depreciation on that leased asset, and we'll still have interest portion of the lease payment. So that treatment is just like it was before. The difference, of course, comes in operating leases. So now it's no longer off balance sheet, it's on the balance sheet. But we still will characterize the payment, those monthly payments, as an operating lease expense. And then we will then treat with the interest expense a little bit differently. So the actual mechanics of recording them are different, and the amounts as far as the breakout between the depreciation and the rental amount will hit different parts of the income statement. But these are fairly technical differences. The overall idea is they will no longer be off balance sheet. They will show up, and then with the impact on the income statement will be roughly the same. IFRS 16, we will capitalize both. That is consistent, but there's no distinction in the accounting between finance and operating leases. We will depreciate, actually we call it amortization since we don't own the asset. We amortize the lease asset and we recognize the interest expense portion. In this case, IFRS is easier to implement than FASB. All right, so now we're going to get a little bit into the weeds. I'm warning you, right? We're going to do the accounting for these leases. We're going to start with a finance lease and then do an operating lease. All right, so let's look at an example of a finance lease, and we record it as, air quotes, purchase and debt. Right? We bought an asset and there's debt. All right, so a company needs a new computer facility. It's worth $700,000. The monthly lease amount is $12,500. The lease term is 16 months. The total payments is simply multiplying $12,500 times 60, or $750,000. Pretty straightforward. The implicit interest rate, which we're giving you, is 5%. Now, how do you find it if you don't get it is off the main purpose of this video, but we can always find a way to estimate what is the interest rate that the company would have paid if they were to have borrowed to buy this particular asset. So we will call that the implicit interest rate, 5%. The useful life is 6 years. We're going to need all this for the tests that for FASB purposes is to distinguish, because there's still a difference in treatment, between finance and operating. A finance lease needs to only meet one of these 5 criteria. So it's pretty easy. There's no partials or whatever. 1, and you're a finance lease. None, and you're an operating lease. Right? That's the decision rule. What are those 5 tests? Does the title transfer to the lessee at the end of the lease? Let's say no, that the owner or the lessor of this computer equipment wants it back. They probably don't, but they have the right to get it back. So let's say no. Is there a purchase option? And that you look through the lease, is there not a purchase option? No. It's fair market value. So that's a no. Third, is the lease term the majority of the life of that asset? So we have the life of 6 years. It's 5 years. 5 divided by 6 is 83%, and it's greater than the threshold for the test, which is 75%. So yes, check mark. It is a finance lease on the basis of the percent of useful life. The next test, we don't really have to do it since we've already met the criterion of one of the 5, but let's just do it for completeness. Do the payments total the majority price of the asset? Again, we use present value. So what is the present value of the lease payments? That amount here is $655,000, which we derive in Excel with a function PV equals PV. You enter the interest rate, the number of periods, the payment amount, the monthly payment amount, the future value, if any, and then the type. We'll do this specific calculation in a moment, but that's how we get it. And what's the fair value? Here, we're given that it was worth $700,000. So 665 divided by 700 is 95%. Ding, ding, ding. Again, it meets the test. So we qualify under 2 of the criteria to be a finance lease. The percent of the useful life and the payment, the majority payment being in excess of 90% of the value. And the final test is the value specialized such that no one can use it at lease expiration. So this particular computer equipment wasn't so customized for the client that no, if the lessor gets it back, it can release or sell it to somebody else or use it themselves. In this case, let's say no. So we passed 2 of the 5, which again, we only needed 1. So yes, this is a finance lease. All that work for that. So now we say, now what? What do we do now that we know it's a finance lease? So now we have to look at how do we do the accounting for it. I'm going to start with some general calculations to warm you up and then move into the actual accounting entries. First thing is that upon signing, we're going to have to determine what is the value of that asset and the amount of that liability. We already said that, this present value calculation led to a value of 665. So that would become a number on day 1, or day 0 actually, at the inception. What is the asset and liability that shows up? Okay, that's pretty easy. Next is, well, what happens when we make our first payment? Well, we're going to be making payments of $12,500. So the first thing is we know that cash goes out, so we're going to be reducing cash by $12,500. So now we know we made a payment of $12,500, but that's today's value. There is a little interest portion. In this particular case, the way that typical leases are structured is the first payment is upfront on day 1. So there is no interest because you haven't borrowed any money yet. So that means your interest for that very first payment only is 0, which means the entire amount of the payment all goes to reduce or amortize the lease liability. So that's the wrinkle, right, for the payment one. The accumulated asset, we take the total of the lease payments and divide it by the period. In this case, $665,000 divided by 60 months is $11,000 per month. So we hit the income statement for amortization expense of the right of use asset for $11,000, and then we will create a contra account similar to depreciation, but again called amortization, which will go against the leased asset of $11,000. Okay, that was the first payment. The next payment comes, and now we do have an interest portion. So the only difference between the first payment and all subsequent payments is the interest that was embedded due to this implied interest rate that we found or used to that $12,500. So yes, we made the same payment, $12,500, but 5% of the remaining balance for 1 month is $2,719. So of the $12,500, $2,700 is for interest, and the rest, $9,781, is against principal. Air quotes again. So that's the entry. We're going to show cash went down. It always goes down by the same amount. And there's a portion of interest, and the rest of it goes to reduce the liability. Now, the amortization piece is the same. It's straight line anyway. So we're going to take the total lease payments divided by 60, which is the same 11,000. So we're going to be doing that over the life of the lease. So that's the accounting for finance lease. You might say, well, how do the entries look? We've all learned those accounting stuff, right? We have to do entries. You probably don't want to do that, but we're going to do it anyway, since this is an accounting class. All right. So we're going to use the template method, and I've only captured partial accounts: cash, the right of use leased asset, the accumulated amortization of the leased asset, the finance lease liability, retained earnings, and then on the income statement side, the amortization expense and the interest expense. Lease begins. There's the easy entry. Asset goes up, liability goes up. First payment, I should call it first payment, not first month's payment, but first payment. Cash goes down, $12,500. The liability goes down in its entirety by $12,500. Why? Because no time had passed. The amortization is that 1/60th of the total amount of the asset, because the straight line is going to end up at 0, and so that's 11,000. So we see on the income statement, we only had one item for the first payment, only an amortization of the asset, because there was no interest for that payment. Next payment is where it starts to differ. Same $12,500, cash goes down. The lease liability is going to go down by the amount excluding the interest. So $9,781, because $2,719 is interest. So now the payment shows a portion of interest expense in the income statement and a portion for the amortization in the income statement. So that's the accounting for finance lease. You say, well, what about the other 58 months? You probably don't want me to do 58 more entries, because it's the same logic as that second one, as your second payment. There's a portion that will be declining of interest, because as you pay down your amount owed, interest will go down and down and down, eventually to extinguish the liability. And then the depreciation or amortization, as it's called for leased assets, will be the same 11,000 all the way for 60 months. And by definition, since the entire amount of the lease is divided by 60 anyway, at the end of 60 months, it will go to 0. All right, so that's a finance lease. You said that was the easier one? Yes, I did. Let's do operating. We're going to convert this so that it will then not be a finance lease. So I've kind of changed 2 items, just 2 numbers. One is the value of the asset, now is $1.2 million, and the second is useful life, is now 10. So boosting up the value and up the life will then make those 2 tests fail. So we apply the same 5 tests. Now, items 1, 2, and 5 all are no. They were no before, they're still no. But item 3 is now no, because the period of lease is 5 years and it's 10 years for useful life. So that's half, which is below 75% threshold. So no, that's a no. The other is present value of the payments. The present value is $665, but now against $1.2 million. So that now is 55%, which is below the 90% fair market value. So no, 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 no. So this is an operating lease. Well, how does the accounting work under FASB if it were an operating lease? We're going to go through this a little more slowly because it's more complicated. So first, to record the lease at commencement on that first day, we have to create the liability and the asset, which is the same thing we did previously. So we know how to look at creating that present value, and I'm going to do it in a little more methodical way here, is that when we do a present value calculation, there's only a certain number of parameters. The parameters are interest rate, the number of payments, the payment amount, the future value, and the type. So let's fill in the boxes here. The interest rate we know is 5% per year. That per year is going to be important in a moment. So 5% per year. Next is the number of payments, 60 payments, 5 years, 60 payments. The payment amount is $12,500. That doesn't change. and the future value is 0. At the end of the lease, you don't pay any more. Now the next part is quite important. The type. We normally don't even fill this out or put in 0. Here you put in 1 because leases typically are structured so the payment is up front, not after the month is over. That's what we did earlier. So we're showing how do we factor that into the present value calculation. And it's a parameter. Present value formula in Excel is equals, and we use the same thing we just discussed, equals PV, open parens, the interest rate, in this case 5% annually, must be divided by 12, comma, the next parameter is 60 months, that's already in months, comma, the payment amount, which is $12,500, comma, 0 as the future value, comma, 1. Don't forget that 1, because that specifies that the first payment is up front, not at the end of the month. We hit enter at the end of that expression, and we end up with 665, right? So that's how you actually do the Excel formula. I didn't do it earlier, just went through it quickly, but here, if you want to replicate it, you can. So this is the amount of the asset. So we know we're going to show this amount as the asset. The other refinement that we're going to do is, there's a requirement in accounting for a classified balance sheet to show short-term and long-term, defined as 1 year. In this case, we have to find what is the amount of payments, the liability, for the short-term portion, and what's the amount of liability for the long-term portion. For this, we look at what is the present value a year from now, and that is the amount for beyond 1 year, right? And then that is the long-term. And we subtract, or we could actually do PV calculation, the shortcut, simply subtract that from the overall 665, and we'll get the short-term portion, right? There's a spreadsheet that I'll show in a moment that does this in great detail, but that's the logic of the entry. So we're going to be entering this, essentially breaking out the 665 into short-term and long-term. It's really an accounting refinement, if you will, because the liability, as we did shorthand earlier, is the same number, 665. Next is we create the right-of-use asset, which we already know is equal to the asset. So we have the pieces of the entry showing up now, and that is the last of that first entry. The second is we record the first payment on the first day, and no interest was due. So cash goes down by $12,500, and short-term liability, because it's within a year, goes down $12,500. The calculation for rent, because the accounting for FASB is different, the entire amount of $12,500 is charged again against rent expense or lease expense of $12,500. The other $12,500 creates a contra asset account for amortization of $12,500. That's quite different from finance lease. There was no interest to worry about because the first payment was on the first day. So that's it for that first payment, that first $12,500 payment. So now we're on to the second payment. What happens now? Very similar pattern. We have cash going down, $12,500. Short-term liability goes down, $12,500, because it's within the year. And then we now have that same amortization where rent expense is $12,500, as is the cash going down, but the interest rate kicks in. So we'll show interest expense of $2,719, which again is derived by taking the balance of the liability times 5% divided by 12. That leads to $2,719, which is an interest expense. So now we have the raw material for the entries for the template. So here's the template. Lease begins, same as finance lease. We create an asset, create a liability, but we did it more precisely. We broke out what's due in the first 12 months from what's due in the next 12 months. The next piece is that we made the first payment. Cash goes down, the liability goes down. And the amortization of the asset, $12,500, goes $12,500. So that's the first entry. The net effect is cash went down and expenses went up, right? Pretty simple. Then the second payment, the same $12,500 goes down and it goes against the short-term liability. We still have the amortization of the asset, which is the same number, $12,500, but we offset that by the interest portion, which is $2,719. So this is a different treatment from finance lease, where we take the total PV and divide it by 60. Here we don't. We take the $12,500, but we offset it by the interest portion, and that's where we create the interest expense. So the end result looks very, very similar, but the steps are different. So that's the operating lease accounting. Now, I could have done this for each of the other 59 months, but it's perfect for a spreadsheet, a schedule, if you will, that would show how does the asset amortize over the 60 months and how does the liability decline over the 60 months. I didn't do this alone. I looked this up online, as you probably would do, and I referenced there this very good video that explains the accounting in more detail than I've gone through, and has the downloadable spreadsheet. So if you're really into this and want to see for yourself the Excel spreadsheet that does this for the entire 60 months, you can, which is the more precise way accountants would do it. They don't really want to do one by one for many reasons. It's tedious and maybe has an error. But worse is what happens at the end of the 60 months of accounting and you're off. So they much rather do an entire amortization schedule, make sure that it works perfectly, and then use that schedule for each of the 60 months so there's no mistake. Accountants do a lot of tedious detail, but one of the rules of accounting is you only want to do it once. If you do it right once, the entry, you don't have to go back and fix it. What accountants hate is do it wrong, and then later on you find something's off and you go scurrying through to find the error and correct the error. That's just a nightmare and a huge time sink. So the methodology that accountants would use, create a schedule, in this case an Excel spreadsheet, then use that, test it to make sure it's right, and then use that for each entry, and you'll always have it done correctly. In the spreadsheet I've shared with you, which is my spreadsheet, I explain this in more detail and how we prove that the table does work and that you could use all 60 numbers. Now we're going to say, well, what about the financial analysis implications? These changes in ASC 842 and IFRS 16 have dramatically changed how balance sheets looked. It does change some of the income statement too, but it's not nearly as dramatic as the impact on the balance sheet. If you're doing financial analysis, the ratios will now be all mixed up, because previously you had lower asset values and lower liabilities. Now they've both pumped up. And by the way, these were done retroactively. So on the date of adoption, there were jumps in the balance sheets of these companies that had to now adhere to the new accounting rules. But since these changes were made fairly recently, 2018 for FASB and 2019 for IASB, the analysis that you do might include pre and post, and you want to make sure that you're comparing apples to apples. So that's an adjustment that you have to be aware of. And since the assets and liabilities both increase, the ratios themselves would change, some dramatically, like one that shows a reliance on debt. There's more debt, so things like debt to equity will be dramatically different. And ratios that relate to assets, like return on assets, profit divided by assets, will also change dramatically. And there are other examples of ratios and trends that you would also see as you do your analysis, because of the same reason we cited. There are many compelling reasons to use leases in a company to acquire the assets you need. It's better than the alternative of financing or paying out of cash. FASB and IASB both made changes that were very, very similar recently, 2018 and 19 respectively, specifically changing the accounting for operating leases. As such, the financial reports and analysis have changed as well. And we have to be aware of that as we're looking at, especially that transition period, but even now going forward, that we have a truer sense of the financial obligations and assets under control of the company. And a summary of the changes for FASB and IFRS is the accounting rules differ. We saw that FASB 842 provides capitalized leases for the balance sheet for both operating and finance leases, but it shows the expenses for finance leases as amortization and interest, and for operating leases you see the rental expense. So it is in a different line. It's depreciation for finance leases and lease expense for operating. IFRS makes it easier because IFRS 16 doesn't show that distinction. There's always an amortization of the asset and always an interest expense. I hope you understand more about leases than you did previously. And again, I haven't even covered all the technical aspects of the accounting for leases, but I hope this helps you understand how the financial statements are generated, and when you're doing financial analysis, how you have to take this account, especially if your analysis period overlaps the transition period from the pre and the post approaches to operating leases.